Hey, I'd like to welcome everybody today to our quarterly IT Nation Grow webinar. We've got an outstanding panel that's going to have what really amounts to a kind of a fireside chat here around some important topics, specifically around navigating change. So as we lead up into the themed webinars and the themed events that we have around, say, planning and preparation, this fits very well as we have to think long term in terms of how we navigate that change. So I'm going to jump right in, lead off with our panelists. And Sydney, I'd ask you please to introduce yourself, and then we'll move through everyone else.
Thanks, Scott. Happy to be here. My name is Sydney Hockett. I'm the Vice President of M&A at Evergreen Services Group. We are an aggregator that acquires MSPs. We have a portfolio of 100 globally. We hold them forever, and we do not integrate and roll up our businesses. So operating in a very decentralized manner. I personally lead all of our MSP acquisitions, very involved with sellers all the way from the very early conversations that may be 2, 3, 4, 5 years before they sell through closing a transaction. So kind of start to finish there, and that time length can vary, but here for it all.
Outstanding. Thank you for being here. We're going to come back to you in just a minute with a good question about kind of the global perspective on M&A. Abraham, welcome. Welcome. How about an intro, please?
Sure. Thanks, Scott. I'm Abraham Garver. I founded the MSP team within Focus Investment Bank. Excuse me. And we've been fortunate over the past 5 years or so to work on transactions with buyers and sellers, on transactions with about 80 different buyers and sellers, and have been the catalyst for 12 platform transactions and have a couple more platform transactions that are working towards close here in 2025.
Excellent. Welcome. Welcome. It's always great to have you. Jay, a growing team, as I know, as I see on social media. Talk to us a little bit about Embark Advisors and you.
Yeah, thank you, Scott. It's great to be here. Hi, everyone. My name is Jay Jung, founding partner at Embark Advisors. We're an M&A advisory firm. My background, I used to be an investment banker at Goldman. I also did consulting with McKinsey and Company. So when we started Embark, the idea was to kind of bring that top-level advisory to the middle market. We started off as an M&A advisory firm. We bill hourly. We don't take a success fee. That makes it a little different in how we approach the market. By virtue of billing hourly, we're able to kind of expand our scope to serve our clients. We will do our own quality of earnings when we get companies ready for a sale. We also have a CFO services team. This is former CFOs that have taken companies public, that have worked under Thoma Bravo portfolio companies, Apollo portfolio companies, help companies get ready for a sale. So we often work with MSPs even like 18, 36 months in advance to help them get ready for a sale, optimize value, continue to grow, optimize on taxes, and then eventually maybe do acquisitions and ultimately sell the business. So a little bit different flavor to M&A advisory. And yes, we are growing. We're always hiring. So if anyone's interested, please reach out. Thank you.
Yeah, we're glad to have you. And certainly last but not least, Greg, IT Valuations, longtime supporter of IT Nation Evolve, M&A peer groups, and Grow. Introduce yourself and tell us a little bit more about IT Valuations.
Yeah, thanks so much, Scott, for having me. Greg Northrup at IT Valuations. I oversee our valuations here at IT Valuations, but IT Valuations also does mergers, buy-side and sell-side advisory services. Has done about 50 transactions in the last 6 years, and all in the MSP space, and all of our valuations are in the MSP space as well. We have our own application where we do ongoing valuations for clients, where we help kind of give them advice on what levers they can pull within their business to help grow their value ahead of selling, as well as help calculating the ROI of acquiring other businesses and really doing some of those mergers or some of those acquisitional kind of aggregating of values so that they really understand what is the value of doing an acquisition. So we also have a tax appendage of our organization that I oversee as the managing partner there, where we do tax compliance and advisory and consulting services strictly for IT service companies as well.
Great, great. Appreciate you all being here. I want to jump in. Sydney, let's lead off with you. By virtue of your organization being global, I always say that you have a broad perspective on what's happening around the world. So plenty of change happening, maybe more so in some countries than others. Not asking you to put on either a political or macroeconomic hat, but tell us what you're seeing in terms of navigating change among the partners you're working with, either that are members of the Evergreen Lyra family, or that you're simply talking to that are interested in making that business transition. How is change impacting them today?
Thanks, Scott. It's a good question. I think what we've seen is that it has come down more to customer sentiment than anything else. Different than other macroeconomic events, we have not seen massive impacts to valuation, massive impacts to people wanting to sell or not sell. But I think what you do see is a lot of uncertainty. And for human beings, that is a scary thing. So as we think about our businesses that are part of Lyra and Evergreen, for us, a lot of the recent changes and everything going on in the world has led to some softness in desire to spend. It hasn't been a direct impact of kind of tariffs or trade and all that, but more uncertainty around where customers want to spend a lot of money when they want to do projects. And so that's something that, our businesses are figuring out how to partner with them on. And I think when it comes down to future partners, similarly, is now the right time to sell? Is there going to be a big change that has implications for me financially? So I think there's still a lot of unknowns. There hasn't been kind of a direct one-for-one change in what we've seen across the board, but tougher conversations around trying to predict what the next 6, 8, 12 months are going to look like. And that's meaningful when people are thinking about one of the biggest decisions of their life.
Yeah. One quick follow-up to that. Any difference you're seeing among geos? Anything different in APAC or EMEA from what you're seeing in North America?
Well, toe this line carefully, but what I would say is sentiment towards the US changes daily. So navigating some of those cultural differences and relationships is important. I think something that we've done is had to build out teams in each of the geographies in which we operate, and that's been really important to have on the ground leadership that manages kind of our business and future business there. So not massive changes different than what we've seen in the past. I think there are different industry trends that, some are faster, some are slower than others across APAC versus EMEA versus North America, but more so in again, kind of that sentiment piece is a trickier road that we navigate right now.
Thank you. Thank you. Abraham, likewise, similar question. I know you have contact with a lot of partners, a lot of the people in the finance world. What's your take on what's been happening, say, last 3 to 6 months, and puts us in the position we're in from navigating the change that we're seeing?
It's a great question. I think the macro environment, is what it is, and it will change over time. I guess from our chair, I like to use this analogy like when we had the pandemic, there were a lot fewer movies that were produced. It was noticeable during the pandemic. And so kind of everybody consuming that content, kind of got a timeout. I feel like, just the stage we are in the cycle, kind of starting from 2020 when everything was gangbusters, we're in a kind of pandemic phase where there's a lot less movies, kind of quote unquote, being made. There are a lot less assets. I had a colleague this morning tell me one of the MSP assets that we have in-house that will come as either an add-on or a platform that quote unquote, it's the best MSP that they've ever seen. And that's very, very, very rare. I would say there are many, there are many assets that are out there that are roll-ups of businesses that are not growing organically. And I think those are especially challenged right now at the moment. And I think it has less to do, I think this is just a classic econ 101 supply demand. We've got, just a limited number of assets that come out. We have a lot of very, very, very sophisticated buyers that will say, this is great, it's got organic growth, it's got great retention, or kind of, put my nose up and say, this is not a good asset, and on to the next, what's the next thing you've got coming? So
Yeah.
very, very few down the center that are, kind of above average businesses. There may be some standouts, but a lot of a lot of the inventory, I think has been picked over really well at this stage.
Yeah, yeah, good. Quick follow-up. You mentioned Econ 101, supply demand. Is there still what we hear, that massive supply of dry powder sitting on the sidelines, or where do you see that today?
Yes, I'd say there hasn't been any new dry powder coming into the market, that it's relatively stable. But there in any process, if you want, there's 100, 125 buyers that are happy to take a look at an asset, and just a lack of supply of really quality assets.
Yeah, good, good.
So
Jay,
the coaching is key. I think the coaching of the peer groups, the coaching of the SMEs on the phone, coaching to help you know what to steer towards is super important.
excellent, excellent. That dovetails well into my next pun intended, Jay, with you. If we're embarking on a journey, we're in our boat, and maybe it's a little choppy. Maybe you say it's not choppy much now compared to other times in history, but we're about to set sail going forward. Look forward for us. Uh, However, again, you say where we are today, over the next year, from what you see, should we expect, from your perspective, more changes, about the same, pretty much smooth sailing? What are you thinking?
Yeah, I don't think it'll be smooth sailing. I think if we look back at the first administration, smooth is not the adjective we typically use for it. But I will say, generally, it is a business friendly um, regime, and I think everyone expected M&A to pick up, become more business friendly. I think in general, there's a lot of noise to signal right now. So it's important to sift through that noise. Even if you look at all the commotion around tariffs and whatnot, what was initially kind of thrown out there is not where we're landing right now. And so, I generally encourage our clients to step away from Twitter, not watch the news all the time, and really think about what's impacting their business. And the reality is, a lot of that tariff noise is dying down. Everyone still expects additional rate cuts to happen. Rates are stable, and there might be more cuts, which is icing on the cake for buyers, to happen down the road. So I do think M&A is going to pick up. I think there's another very important, from an M&A perspective, important change there. There's been a big change in the FTC. So you've seen big companies like Google and Salesforce start doing bigger deals. IPOs have picked up significantly this year versus last year. So again, if you pick up the signal versus the noise, I still think we're in a more positive environment and headed towards a more positive environment for the latter half of 2025 and 2026.
So I'm going to follow up. You're a big brain kind of guy. I heard Goldman, I heard McKinsey. Let me ask a question. Why should a SMB MSP care about the environment at, Lena Khan's no longer in her role, or the bond market? We hear so much about the bond market. Um, is that really relevant to the typical SMB MSP?
Well, I think I know Evergreen is a different model, but I think for many other buyers, at the end of the day, they have to return capital to their investors, their LPs, whether endowments, pension funds, et cetera. And the fact that M&A and IPO markets are opening up, means that there is a eventual final exit path. And so that helps capital get recycled. And also kind of seeing where that prevailing valuation is at the end of the road allows the buyers and the investors to kind of do the calculation at what can I pay today if I am targeting a whatever 20-25% IRR, or three to five times
Mhm.
multiple on invested capital. Allows them, by knowing where they're going to end up, they can underwrite the deal today. And that's why, as Sydney mentioned, uncertainty is almost like poison to underwriting deals. And the more stable the environment becomes, the more activity we'll see. So I think some of these incremental changes are in the right direction.
Yeah, I appreciate that. That's uh, good and clear to help us, gain some understanding. I think that a lot of times there is some uncertainty in that space. It's many times owners are running so fast in terms of running their business that it's nice to have that perspective. Greg, IT valuations. Talk to us a little bit about the valuation side And let's lead off with that. What are you seeing from a valuation perspective broadly in terms of the businesses that you work with? Say, go back a year or two, where we are today, and look forward, say, a year or two. What do you think's same and different?
So this kind of goes back to both what Abe and Jay kind of alluded to on Abe's point around kind of maybe a lack of inventory or lack of good assets. We're really seeing a lot more risky companies, or just risk being kind of more of a talk track when it comes to valuations. So when you have a company that has more risk factors present, that is having obviously a negative impact on the valuation. Although I would say multiples as a whole have either held steady or even slightly ticked up due to that law of supply and demand, where all of a sudden when you're seeing certain deals get done where there is a really prized asset out there and available, well, now that asset or that company is able to command maybe a slightly higher multiple, which makes the deals in the marketplace seem artificially higher. But we're not necessarily seeing that on all valuations across the board, because it's only those select companies that are truly actually achieving that higher valuation. So it is key to point out that, yes, to Jay's point, the macroeconomics would suggest that there's deals to be had. There's opportunities to be had for these MSPs at a higher valuation, maybe a half turn to a full turn higher EBITDA multiple in some cases, if they find the right partner and they have the right risk profile. But it really is putting an emphasis on these owners to really invest in their risk profile analysis, pull the right levers, and de-risk their business in order for it to be in the best state possible as they go to market. Because we're just seeing too many times a seller comes to market and now all of a sudden there's more risk that is coming up, out of the woodwork and being presented on the deal table. And now we're seeing due diligence take longer. We're seeing the QOVs take longer. We're seeing, potentially retrades take place, all because there's just more risk factors present and buyers are just more sensitive and more sophisticated in sifting through those risk factors.
Yeah, that's great. And I'm going to let's follow up on that, and we'll get everybody's perspective on. You kind of alluded to this on changes in deal structure, and you mentioned some of those potential options. And before I again come back across the panel, share with us your perspective. Are you seeing any changes in deal structure based on the changes that we're seeing in the broader economy, or interest rates, or levels of uncertainty? I'm one who believes that a lot of the questions that come up in deals are, just as you really kind of doubled down on, the concept of managing risk, understanding risk, or de-risking the business. Talk to us about any changes you're seeing in deal structure.
Yeah, I would say the deal structure changes we've seen has been more due to the risk profile of the company and less to do with some of the macroeconomic factors at play. When you're thinking about customer concentration, owner dependencies, lack of organic growth, lack of profitability in some cases. Like when you have some of those different risk factors at play, we're seeing a larger amount of conditional seller notes, or in some cases earnouts, where there are different provisions or conditions placed on the sale, because we can't give you your multiple that you desire unless you hit these objectives. Now, some groups are able to get around that with some, a larger amount of rollover equity, because then it's like you're investing with us as part of that journey. But when you have too many risk factors at play, that definitely has an impact on the deal structure at large. Now, generally, we're still seeing about 60% cash up front, is maybe as high as 70 or even 80 in some rare cases. I know like every PE group is different, like Evergreen has a different model than maybe some of the buyers that Abe and Jay are working with, but generally you're somewhere in that 60 to 80, 90% cash up front and the rest is deferred. It's just a matter of the conditions at play for that deferred portion that we're seeing kind of change a little bit on the risk profile.
Yeah, great. And that's a good opportunity to jump back to Sydney. Sydney, Evergreen's done, you've done 100+ deals out there. Is there a template deal? And I'm not trying to get into the specifics, but has your deal structure changed over time, or is the Evergreen deal pretty much the same today as it's been, and you see it going forward?
It hasn't changed materially. I think it does on a case-by-case basis. I would agree with everything Greg said. For us, our typical deal is 80 to 95% cash at close, and then typically a 1-year earnout tied to EBITDA growth. we are flexible on what founders do. And so particularly in cases where they're not staying around, it doesn't benefit us to have a ton of the structure tied up in long-term performance targets. It makes the transition complicated. But for some businesses, I think to Greg's point, for areas where there are higher risk factors, we do generally come to a more structured deal. So a good example is a business that has unusually high EBITDA margins. Business running at 30% plus EBITDA margins is much higher than best in class that you see in the MSP space. You can look at it in the SLI data. And so in those cases, for us, we ask the buyer to share in some of that risk for us. You may see a few more earnouts, a longer term structure that, will pay out more, assuming the business can sustain the margins that they're putting in front of us. So it varies a little bit for us. Equity is not a required piece of any deal. It's an option for us. I think that's something that's changed is, we do have more sellers roll over now than we did early on. I think that's been, become a very attractive part of selling your MSP is the opportunity to roll into a larger entity. So it's certainly something that is available with us, but again, not something we require. So I think it's more about the individual entity. And I think what those changes have been across the MSP space are what's driving the changes in deal structure. We're seeing higher customer concentration. We're seeing lower growth businesses. We're seeing higher customer churn. And not all of those things are always the MSP's fault. But again, the buyer and the seller sometimes have to share in the risk of those things. And so that'll determine changes in deal structure.
Yeah, yeah. Sydney, I know you well enough that you'll take this question in a good sense, and that is simply, why does when Evergreen, quote, loses a deal or a deal doesn't happen, what are the most common reasons that doesn't take place?
It's a good question. I think number one is probably when somebody actively wants to be rolled up into a larger entity, to take on a larger national brand, to become part of another team. That's fundamentally not our model, so there's never going to be a fit here. I think that is generally the main reason. I would say usually, when we don't end up being the preferred partner in other deals, it usually is evaluation. I think something that is really important to understand is that there is a set kind of range of valuations that buyers pay. The deal structure is more important to pay attention to because you may see these really high multiples and 30% of that is in cash at close. You see a lower multiple, but you're seeing 95% of that in cash at close. I feel like people get really stuck on the multiple, but it really depends on the EBITDA that's being underwritten and the structure that's coming in. And the reality is most buyers are operating in the same valuation world. It's just how they manipulate the different pieces of that. And so it's really important to ask the second and third layer question around what's actually going into that multiple. How is it getting paid out? What is the reality of how much money you see? If a ton of that is equity, you should be asking for historical performance. You should be asking for future projections. You should be very clear on the path of that equity and when, you can and will see a return on it. So it's generally not a just one for one. Oh, we paid less, someone paid 5x more. That's not how it goes. It comes down to things around the margins. Usually it depends on the relationship. It depends on the model they're looking for. But it's not, it's so black and white as I think it gets made out to be a lot.
Yeah, thank you for answering that. I appreciate your transparency.
Sure.
Abraham, obviously, a couple factors here. We've talked a lot about the need in many cases in a time of turbulence and the potential for change to de-risk. At the same time, there's an emphasis placed on growth. And one way to do that is owner-led sales. There are a variety of ways to do that. Talk to us a little bit about your thoughts on owner-led sales in times of change, or if you're seeing changes in how owner-led sales is happening and developing.
Thanks for that question. I've had some surprising. I had a second conversation that went like this yesterday, and almost it's making me think that there may be kind of a new trend with buyers as it relates to we're also in touch with organic growth and the importance of it from a valuation perspective, and just having it be part of one strategy. I got comments from two PE-backed platforms now that have recapitalized, so they're on to the next kind of war chest of money, doing acquisitions, and in kind of confirming what we've seen all along, which is they're looking for targets with high organic growth. What was really surprising, and I've now heard it again 2 times, this recapped PE, 2 recapped PE buyers saying, you know what, it's not like, it's more important that culturally that MSP has been growing in the past, that all the employees that are there, if the kind of the entire business is trading, we kind of the comment was, we're going to put our own marketing machine that we've got with our large PE backed platform into that market. We're not going to depend on, if they built in non-owner led sales organic growth engine. Historically, to me, that's kind of always been my advice, is build something that is an organic growth engine that is not going to be dependent on the owner. But really what I'm hearing these buyers saying is, we just really prefer that. We do want them to be growing, but it's the environment's important, because we're going to pour a lot of gasoline using our marketing system that works onto this new MSP that we acquire. And probably whatever they built is less important. So it was just really a wake-up call to me to hear that next larger buyer saying, we're going to do it kind of our way. And it's, what's more important is that you have a culture of growth that's going along at 10, 15+%, versus like, that's attractive to buyers. That's attractive to some of these larger buyers. Right now, it's just having the culture rather than an owner who's the sole person, or a non-owner being the sole person bringing in business.
Yeah, yeah.
Scott, can I comment on that?
You bet.
Love to hear your comments.
Yeah. I think what's a really important piece of that is that owner-led sales does not often equate to the culture of growth. So what I wouldn't want people to take away is that owner-led sales is preferable. Like, a growing business is preferable. I think we're probably different than some buyers in that we would prefer not owner-led sales. It's not a non-starter for us, but I think the bigger problem is most businesses are not actually operating in a growth-oriented culture. And I think what we're seeing is the tailwinds of security upsell, cloud upsell are kind of tapering off. That's been executed on across businesses. It drove a lot of organic growth. And now there's only so much you can capitalize from that. We're seeing increased customer churn due to M&A. Nothing you can do about that. But the reality is you have to be adding new business in a very systematized way, not from, just the relationships made through social networks that the owner has known their whole life. So I think the important distinction there is whoever is leading the sales, and you should talk to different buyers on what they prefer there. And I think if you have a longer timeline, it is worth investing in someone outside of the owner. But I think the reality is most owner-led sales organizations are still not a culture of growth. And so you still miss that piece.
Yeah.
That's great. That's great. Now, Jay, you're advising a lot of partners in this space. Help us understand 1 or 2 areas that you find the biggest gaps, or where you believe that they come to you and you say, if you would have just done this before you came to me, your situation would be much better. I would be better, have more opportunity to find a matching buyer. Help us get inside your head to what you're seeing and what you're advising on.
Yeah, I think there's 2 things. One is, right at the point of sale, I think people have to do a seller's quality of earnings. Doing a seller's quality of earnings really measures what your true EBITDA is. It's the equivalent of knowing what your actual square footage is of the home that you're going to sell. If you don't do the quality of earnings, you're kind of rough. There's a lot of margin for error, and good chance that you're going to leave a lot of low-hanging fruit on the table. That's an easy one. I think the harder one to do, that requires more lead time, is kind of getting into the habit of building a forecast, tracking, and then executing against it. I just talked to one of our clients that sold 2.5 years ago. Their EBITDA nearly doubled from three something to almost six now. So I asked them, hey, what changed? What are you guys doing differently? Because it's still the same team. They're kind of still held relatively independent from the mothership. And they said, well, the biggest difference is now we have a forecast, we have a budget, and we have to hit it. If we don't hit it, the private equity bosses tell us what's going on and they push us to do it, and we can do it. We just never kind of pushed ourselves. No one held us accountable to do it. And that's really what the CFO and the forecast does. It's to hold the business accountable and make sure they push the levers to do that. It's something that I think anyone can do. And this is kind of case in point, right? These guys were successful. They sold their business. But even after that, when they had that additional layer of accountability, they were able to far outperform what they had before. And I think every business owner can kind of do that if they have the right coach, CFO, accountability partner, what have you, to allows them to set a plan, act on that plan, and whenever you feel you're falling short, have someone push you to go that extra mile.
That's great. And I think you're right on. That's whether it's 10 years in advance, that can be peer groups. As you grow, like you said, that could even be a fractional CFO. And as you even grow further, that could be a board or a group of advisors, however that would work. So I'm going to put that right in the category of one great piece of advice in the overall planning and preparation. It's not the type of thing you want to be doing the year before you plan your exit. Greg, I'm going to come to you and I'm going to ask a question on, first of all, excuse me, before I ask about one recommendation that you have, is going to be on taxes. And what are you seeing as it relates to taxes that a SMB MSP should be aware of, concerned with? I know we're literally right in the middle of some negotiations along those lines, but I'll leave it open-ended for you on that question.
Yeah, I mean, taxes is a multifaceted answer, as you can imagine, right? Everyone's tax situation is different. But it's important to note when you're trying to think about your exit that you are factoring in, okay, what is my net cash, my net take home at the end of the day? And that plays into what Sydney was talking about with deal structure, right? The deal structure matters on what you're going to take, what's your take home, and when are you going to take it home. And all that deal structure also has an impact on taxes. So to the extent you're getting cash now in a deal, that obviously is going to get taxed. Now, generally, because of the marketplace, we don't have asset-intensive businesses that are being sold. So generally, that's a capital gain. But what are some things you can do to maybe minimize that capital gain impact beyond just planning for the fact that you have a capital gain? I mean, there's a couple of different options. Like one, if you have a longer horizon and you fit the right profile, that it maybe makes sense for you to look into it. I know Jay and I have talked about this before. The Section 1202 qualified small business stock is an option, and it should be something that is looked at. I don't necessarily advise it for everyone. I think you have to find the right bucket, and you have to have the right partner, like idea of what your partner is when you exit, to really say that that's the right path for you and your business. But if you're not going down that route, one thing that every business could look at is what is their state tax profile, because that one you have maybe a little bit more control of now ahead of a sale, where you can actually look at your apportionment, you can look at your residency, you can look at how your business is organized. And there's even some things you can do from a restructuring standpoint to get yourself out of certain states. If you're trying to get out of California or New York or one of those high income tax states, you can save a lot of money from the state tax standpoint by just moving a couple of little things around versus the federal side of things. The only way you can really dodge the feds is looking at that Section 1202 option, which is not a one-size-fits-all approach that makes the most sense for everyone. So that's where, how can you look at the full totality of your tax profile and see what makes sense for you, as well as try to save money along the way? What are some credits you can take advantage of? What are some tax savings opportunities you can take advantage of leading up to a sales event, so you have more cash in your pockets to deploy in acquisitions, to deploy in growing your business, so you're not, again, leaving money on the table all throughout that journey.
Yeah. So if I was to say, what's one thing that you would advise an MSP to do? Let's say they're 3 to 5 years out from making some transition, typically an exit of some form, even if they're going to continue working in some form. would that look at their tax situation be what you recommend, or is there something else maybe specific that you guide them towards?
Yeah, I would say when you set up your MSP, most people are generally S corps in the space. And that might have been the right option for you when you started your MSP back in 2002. But a lot of people don't actually revisit that conversation around their entity structure and their tax profile until all of a sudden it's too late and now they're about to sell. And so what it's really helpful to do is, as a first step, sit down with your CPA and really understand, is this the right entity structure for my business? Where am I headed? What are my goals and objectives? And if I want to grow through acquisition and potentially have the option to do rollover equity as part of that acquisition strategy, well, maybe an S corp isn't the right, entity selection for you because you have limited availability of doing rollover equity in that structure. And so maybe you want to offer, different forms of equity to your current management team. Maybe an S corp isn't the right structure depending on how you want to accomplish that goal. So it's really understanding where are you headed, and that kind of dictates what is the right strategy for you now to tee up that eventual exit in the future.
And that's great. That aligns exactly what we're going to be talking about and we do talk about at IT Nation Grow. Abraham, I'm coming to you, and then I'm going to wrap up with Sydney. Share with us one or two items you would strongly recommend that someone, specifically an MSP who's considering a transition, again, 3, 5, 7 years out, really focus on as part of their planning and preparation strategy.
I think my number one is new logo organic growth. And we heard it, Sydney made a nice comment about this, that kind of like many MSPs have done the cross sell to security kind of MSSP services. And what's really valuable, what's going to really make this business worth more and more money is setting up a process to get new logo, kind of new companies, new customers in the future. Retain those obviously, but really having an engine that's doing that. And then from this really neat call we've just had, I think we're also collectively agreeing that the culture within the business, not just getting one new logo, but have a culture where you have multiple hands on deck helping pull that new customer in and get them up and going and happy over time.
Thank you. Thank you. Sydney, you're batting cleanup here. As it relates to all this, I'd like to point out for the record that the term AI has not been mentioned on this webinar. And I don't know if to now start to use the term culture and organic growth eats AI for lunch, but I'm not feeding you that the answer is learn AI, but in an organization as large as yours, clearly there are opportunities. Now, I'm not, again, saying you have to answer this, but if you were to advise either your group collectively, your platform, or more specifically, someone that you might be talking to, and they'll say, well, I'm still 3, 5, 7 years out from making this kind of transition. What's your advice to them? What should they really focus on? Something concrete they can take away.
Where do I want to take this? One, if you're going to change the structure of your business, talk to buyers as well. There are some very serious implications to who can buy your business on the corporate form that you choose. So to Greg's point, depending on what you want your path to be, those conversations are really important. If I was to give one piece of advice, it would also be on organic growth. Now, AI can be a big part of that. If you can make your team more efficient in how they process tickets, how they set up desktops, how they increase their response time, those small things internally that AI is starting to prove very valuable for, that makes your team more efficient, that's part of the equation. But I would never say, oh, go invest a ton of money in, building out your own products or buying other ones, because if you don't have an organic growth engine to start with, you don't have team maturity, it doesn't matter. Your business isn't going to be more valuable. So number one would be building out an organic growth engine if you have a longer timeline. The way I look at it is retention and upsell are table stakes, but no matter how great the business is, you're going to lose customers. So either sell now or take the hit and invest in your organic growth engine. And that can look a variety of different ways. And then you'll be in a better place when you want to sell.
Outstanding. Thank you. Um, I I appreciate greatly all of you joining us today. Sydney, Abraham, Jay, and Greg. I'd like to remind our viewers that these webinars, these chats are posted onto the IT Nation Grow public YouTube channel. So you have the opportunity to view a collection of these. The IT Nation Grow events are offered quarterly, of which the vast majority of those events were joined by these subject matter experts, advisors, and many, many more, as well as partners who are going along that same journey. As you can appreciate from this call, there's more to learn than you're going to pick up at one event. That's why we have the win-win opportunity here with the community of great people that are sharing and learning together. So with that, I thank you for joining us. Again, I thank our panelists and hope you all have a wonderful day.